If you've been thinking about investing but have no idea where to start, you're not alone. Most people feel the same way, intimidated by all the jargon and the fear of making a mistake. But here's the good news. Building a profitable investment portfolio doesn't have to be complicated. In today's video, I'm going to walk you through a simple step-by-step guide to creating a monster dividend portfolio. You don't need a big bankroll or expert knowledge. I'll break down the process into 3 easy steps: number of stocks you need, how much to invest in these stocks, and what should be your sector allocation. And in the end, I'll show you and John 17 top-notch dividend-focused stocks I selected for my monster portfolio and demonstrate how it can turn a one-time $25,000 investment into a $2.5 million portfolio. That's a 1,000% gain, and it can also pay over $70,000 in monthly dividend income. But before going into building a monstrous dividend portfolio, let's first see why you need a portfolio for generating consistent income and managing risk when starting from scratch. Inflation and market risk are 2 of the main challenges that you'll come up against first. You will always subject yourself to both in varying amounts depending on your portfolio's asset mix. At 5% interest, a $1 million bond portfolio will provide you with a $50,000 annual income stream and will protect you from market risk. In 12 years, however, the investor will only have about $35,000 of buying power in today's dollars, assuming a 3% inflation rate. Add in a 30% tax rate, and that $50,000 of pre-tax and pre-inflation adjusted income turns into just under $25,000. The question becomes, is that enough for you to live on? Well, it's obviously not, and this is where building a portfolio reduces inflation and market risk. And it's not just these risks you need to watch out for. Going all in on one company can be dangerous too. Remember Enron? What about Lehman Brothers? Going all in on any single company can have severe consequences. On the other end of the spectrum, suppose you bought shares of every stock in the market. For each company in your portfolio that experienced bad news, you'd likely own just as many firms experiencing unexpectedly good news. In other words, you'd no longer be dependent on any single stock to drive your investment returns and dividend income. Your portfolio could weather a few unanticipated storms because it was diversified across a number of different companies. So long as America continues to survive and advance, there'd be virtually no chance of your portfolio experiencing a permanent loss of capital. The market has historically appreciated over long periods of time and will likely continue to do so. Of course, it's impractical for an individual investor to buy shares of every company in the market without the use of exchange-traded funds or ETFs, but you can understand the advantages of owning more than just a couple of stocks. With that in mind, building a monstrous dividend portfolio starts with an understanding of the key risk factors that influence a portfolio's returns and volatility. To help get you started, I've made a simple 3-step process for building a monstrous dividend portfolio. Starting with the first question, how many stocks should you actually own to maximize diversification? Many of the best investment professionals run concentrated portfolios. They invest with conviction behind their top ideas, believing in Warren Buffett's statement that diversification is protection against ignorance. But as individual investors on the outside looking in, we don't have Warren Buffett's resources, connections, and insights needed to responsibly run a concentrated portfolio. For that reason, I prefer to spread my bets over a reasonable mix of different stocks to avoid shooting myself in the foot with a concentrated bet that sours. Look, the fewer stocks you own, the greater your portfolio can deviate from the market's return. So how many dividend-paying stocks should you own to maximize the benefits of diversification? Plenty of people have tried to answer this question over the past 50 years. The American Association of Individual Investors, AAII, in a 2004 article highlighted just how critical diversification is. They said, holding a single stock rather than a perfectly diversified portfolio increases annual volatility by roughly 30%. Thus, the single stock investor will experience annual returns that average a massive 35% above or below the market, with some years closer to the market and some years further from the market. The study went on to offer a useful rule of thumb for reducing diversifiable risk. Holding 25 stocks reduces diversifiable risk by about 80%. Holding 100 stocks reduces diversifiable risk by about 90%. Holding 400 stocks reduces diversifiable risk by about 95%. A more recent perspective comes from a 2014 paper titled Equity Portfolio Diversification: How Many Stocks Are Enough? Evidence from 5 Developed Markets. The researchers with this paper reinforced the idea that a larger number of stocks is often necessary to manage risk, especially during periods of market stress when correlations between stocks tend to rise significantly. In the case of U.S. markets, the study concluded that reducing 90% of the diversifiable risk 90% of the time requires around 55 stocks on average. However, in times of financial distress, that number can climb to more than 110 stocks. But to avoid running your investing thin across 50-plus stocks, average investors with a focused investing style need somewhere between 10 and 25 stocks, offering meaningful diversification while keeping portfolio maintenance manageable in terms of research time and trading activity. In the end, I'll show you and John 17 top-notch dividend-focused stocks I selected for my monster portfolio and demonstrate how that portfolio can turn a one-time $25,000 investment into a $2.5 million portfolio, a 1,000% gain, and it can also pay over $70,000 in monthly dividend income. So you might question, this seems like a lot of effort. Why not just buy an index fund or an ETF and be done? Wouldn't that be less risky? Wouldn't this essentially achieve the same thing and give you better diversification and possibly better returns? Well, maybe. But my goal, ultimately, for this particular portfolio is dividends as my primary income when I'm ready to retire, and with more positions that pay dividends and are increasing consistently over time. And you can only earn a finite amount of dividends and capital gains from a single ETF or mutual index fund, or even several of them across different themes and sectors, without tying up all of your available capital. So each type of investment strategy serves its purpose. Additionally, if you're like me and prefer buying individual stocks, either because you want dividend income or you just like the companies you're investing in, the general idea is that owning more stocks lowers risk. This is because you have less focus on just a few stocks as long as your investments are spread across different companies and industries. Although concentration might be your goal in some cases, especially if there's a particular sector you want to focus on at a certain point in time, and that's fine too. So keeping all of that in mind, I believe I'm taking on less risk with 10 to 25 different stocks. Back to our topic. Once you've decided on how many stocks to own, the next step is figuring out how much to invest in each position. It's tough to make predictions, especially about the future, said the late Yogi Berra, who played professional baseball and never shied away from sharing his unconventional wisdom. In fact, this nugget from Yogi Berra could explain the reasoning behind my next portfolio construction step. When creating a dividend portfolio from scratch, I prefer to roughly equal weight the positions. Why? Because it's hard to know which holdings will be the best long-term performers. The stock market, after all, tends to be quite efficient over time. That's a big reason why even professional fund managers, despite spending millions on research, often struggle to consistently beat their benchmarks. That doesn't mean they aren't smart, it just means the future is unpredictable. And even the best investors cannot reliably pick the winners ahead of time. If they can't, why should we assume we can? We're not any smarter than them. Plus, the market is unpredictable. So by spreading our bets evenly across our portfolio, we reduce the risk of overweighting a poor performer and avoid outsmarting ourselves in the process. Let's break it down. If you or John has $10,000 and choose to invest in 12 stocks, you'd simply allocate about $833 to each stock. If you have $25,000, you'd then invest approximately $2,083 per stock. Simple, straightforward, and effective. Now, if you're wondering what kind of stocks John or you could be investing in and what kind of returns John or you could potentially earn, hang tight. Because at the end of this guide, I'll walk you through how a $25,000 investment can turn into so much more using this monstrous dividend portfolio strategy that I've put together. Before that, you need to know about the last step, which is no more than 25% in any sector, because owning more stocks can reduce risk, but you can still end up with poorly diversified portfolios if you're drawn to certain types of stocks. This is because stocks from similar industries are often sensitive to the same factors and move together in the market. That's to say, they're highly correlated. If a shared factor such as interest rates or the price of oil becomes unfavorable, your portfolio could significantly underperform compared to the market. Picking stocks from different sectors and industries helps diversify away this risk. When some sectors are struggling, others are likely doing well. The pie chart here shows the sector breakdown of the S&P 500. You can see that only one sector, information and technology, accounts for more than 15% of the overall market. My preference is to invest no more than 25% of our portfolio in any single sector, and we try to own companies with little overlap in their operations. However, sector diversification should not come at the expense of violating valuation principles or extending outside of your circle of competence. Just because consumer staples account for about 6% of the S&P 500 doesn't mean you have to buy a stock in that sector if you can't find one that's reasonably priced. Equally important, you should not diversify into a sector or industry that is outside your comfort zone. For example, many conservative people remain underweight in the technology sector because its pace of change is too fast, too confusing. Trying to predict which tech companies will still be relevant in 5 years can be challenging. When in doubt about whether an investment is in your wheelhouse, famous fund manager Peter Lynch provided a helpful test. Never invest in any idea you can't illustrate with a crayon. That says a lot. The bottom line is this. Remember how your mom always told you to look both ways before crossing the street? The same principle applies in investing. The easiest time to avoid risk is before you even start. Before you even put $1 into the market, set your investment criteria, do your homework, evaluate potential companies carefully, and most importantly, wait until the price is right. If you're unsure, wait some more. More mistakes in investing are made by rushing in than by patiently saying no. Look for solid blue-chip companies with bulletproof balance sheets, ideally offering dividend yields in the 4 to 5% range or higher. You can't avoid all risks, but you can certainly avoid the unnecessary ones by being selective and disciplined in your approach. But hey, if digging through your financial statements and screening dozens of companies isn't your thing, don't worry. I've got your back. I've already handpicked 17 high-quality dividend-paying stocks across multiple sectors, all while keeping diversification in check. None of them exceed the 25% sector allocation rule. These stocks form what I call a monstrous dividend portfolio, a balanced, income-focused investment strategy designed for long-term wealth creation. The portfolio includes Viper Energy and Marathon Petroleum in the energy sector, Reliance Incorporated and Southern Copper Corporation, along with Avery Dennison Corp. In the materials sector. There's Watsco and Caterpillar in the industries sector. AbbVie Incorporated, United Healthcare Group in the healthcare sector. Federal Agricultural Mortgage Corp Class C and Progressive Corp in the financial sector, Microsoft Corp and Motorola Solutions in the information and technology sector, NextEra Energy and NRG Energy in the utilities sector, and Equity Lifestyle Properties Incorporated and Terreno Realty Group in the real estate sector. Now, to show how this strategy works, I'm going to put John's $25,000 into this portfolio. For my projections, I've used 3 key parameters from each selected stock. Forward dividend yield, because it gives a snapshot of expected annual income and averages out to about 2.47%. 10-year dividend CAGR, because growing income matters over time, which averages out to 14.41%. And 10-year average share price appreciation to capture long-term capital growth, and it averages out to 15.21%. If you want to know how to calculate these metrics for your portfolio, here's how you do that. To calculate the portfolio average current dividend yield of the 17 stocks I showed you, you simply have to add up their yields and divide by 17, which is the number of stocks we have in the portfolio. The calculation would be 41.92% divided by 17, which gives us an average dividend yield of 2.47%. You can apply the same method of averaging to calculate the dividend growth and share price appreciation for the portfolio. So if you combine these stocks, you'll have a portfolio with a current dividend yield of 2.47%, an average dividend growth rate of 14.41%, and an average share price appreciation of 15.21%. Based on these metrics, let's break it down and see what happens if John invests $25,000 in this portfolio. In the first year, John's investment would grow to about $29,053. By the end of 10 years, that $25,000 would be worth around $113,498, meaning you've more than quadrupled your initial investment. And this is without adding anything extra and only reinvesting the dividends received. After 20 years, your investment would grow to $528,451. That's when the compounding effect truly kicks in, especially when you have solid dividend growth rates. After 30 years, your original $25,000 has the potential to reach a solid $2,530,444. Around the same time, this portfolio will be paying around $72,875 in annual dividend income, or about $6,073 per month in dividend income. In total, this portfolio will add $2,505,444, of which $2,034,659 comes from capital appreciation, while $470,785 comes from reinvested dividends. And remember, that's just from an initial $25,000 investment. Now imagine if you started with $50,000 instead. That portfolio would grow to over $5 million, generating more than $140,000 in annual dividends. Don't have $25,000 for investment? No worries. Click the video on the screen to find out how to make $6,000 a month with only $20 a week.